Hey, are you missing out on these lucrative rental tax breaks? Real estate investors get some of the best tax breaks, but many people are unaware on how to actually take advantage of them. You see, the government offers real estate tax incentives to encourage private investment. Tax benefits also exist because investors and business owners take on economic risk, right? So let's talk about some of these tax benefits of owning rental real estate. The first one is depreciation. When you buy a property, there's going to be wear and tear on that property over time. And because of that, the government then allows us to take a paper write-off over the life of the building every single year. Now, typically, if we're talking about residential real estate, we can write it off over 27 and a half years. What are residential properties? Think single-family homes, duplexes, apartment buildings even are residential property. So typically 27 and a half years. Now, if you're investing in commercial real estate, examples might be commercial buildings or medical centers, business centers. Those are generally depreciated over 39 years. And so what that means is you can write off the purchase price of the building over time. What I love about real estate depreciation is that it's not just based on your down payment of a property, it's actually calculated based on your purchase price. So if I buy a piece of property for $500,000, my depreciation calculation starts at $500,000 if that was the cost of the building. This is true regardless of how much or how little my down payment is. So as you can see, this is a great example of how you're able to use leverage, right? We're depreciating based on borrowed or bank's money and using the tax code to help us to reduce taxes on all of our income. And what I love about depreciation is that we get to utilize it regardless of what's actually happening in the market. So even if the property is actually increasing in value, it doesn't matter. I still get to take my depreciation tax benefit on the building every single year. Now let's talk about the next level of tax planning, which is to supercharge our depreciation. As I just said, we typically can write off our depreciation over 27 and a half years if we're talking about residential property, but we can also accelerate our depreciation with something called a cost segregation. A cost segregation is when you work with an engineering firm who breaks out the components of your building. So instead of saying a $500,000 building, you're breaking it out into different components. And why would you do that? Well, because when you break it out into different components, now your CPA can take faster depreciation. You know, when we look at faster depreciation, what we're trying to do is to accelerate as much as we can write off today, rather than to write things off slowly over time. And as a real estate CPA, I would have to say this is one of the most commonly missed areas, in that most tax returns we review only take regular depreciation and not optimized depreciation. So definitely make sure this is something you're looking into, and don't just assume that your tax preparer is optimizing depreciation for you. Ask them, how much is accelerated depreciation saving me in taxes this year? Now, the other benefit of investing in rental real estate is that you are now a business owner in the eyes of the IRS. And what that means is all of the regular expenses that business owners are able to take advantage of, you can do the same. Now, as property owners, we typically don't miss out on property-related expenses, right? Mortgage interest, property taxes, insurance, management fees. What a lot of people miss out on are these personal expenses that are also used for business purposes. Common examples might be your car expense. If you're using a personal vehicle for rental purposes, then you can deduct a portion of your car expense as a business expense. If you are managing your properties from a home office, you can actually start to deduct some of your overall home expenses as part of the home office tax deduction. So again, once you are a real estate investor, you are opened to a new world of tax write-offs that you can utilize to offset taxes from the rental income. Now, I just talked about using all of the expenses to offset taxes from your rental income, but there are instances where we can actually take it a step further. And what I mean by that is if you've done the right things during the year, you can potentially use these rental tax benefits and losses to offset taxes from other income outside of real estate as well. What am I talking about? Well, W-2 income, income from a business, retirement income, crypto, stock income, the options are sort of endless. Generally speaking, rental losses are considered passive losses, which means they only offset taxes from passive income. If you or a spouse, if you're married, can qualify as real estate professional, then you can use rental losses to offset all types of income, not just rental income. I have a lot of videos where I go into detail about what is a real estate professional, how do you qualify, so make sure to check those out. Effectively, to be a real estate professional, for most people, one of the harder rules to meet is that you spend more time in real estate than your job. So that's why it's very difficult for those who have a full-time job. Which then brings me up to the next strategy of the short-term rental tax loophole. Why do they call it a short-term rental tax loophole? Well, because if you invest in Airbnbs or short-term rentals where the average guest stay is 7 days or less, you actually don't need to be a real estate professional, and you can potentially use rental losses against W-2 and other income. Now, of course, there's always a caveat to that. You can only do so if you meet material participation requirements. Similar to real estate professional, I've done a lot of videos going in depth about what is material participation, how to use this short-term rental tax loophole, but effectively, it's you being involved in the day-to-day operations of your short-term rental property. What I love about the short-term rental tax loophole is that it works for virtually anyone. You could be someone with a full-time job and real estate could be your side hustle, and you can use all of these depreciation write-offs against W-2 and other income. Like I said, there are certain things you have to qualify for. You have to do the right things during the year. You have to document them correctly. But if used correctly, we've seen some very, very significant tax savings, from 10 to even hundreds of thousands of dollars in taxes saved every single year. Now, so far we've talked about some of the tax benefits of owning rental real estate today, but real estate is actually a really great asset class when we're talking about building generational wealth. When you hold real estate throughout your lifetime, and if you eventually pass away with the property in your name or your LLC's name or in your revocable trust name, typically when you pass that on to the next generation, your beneficiaries get what's called step-up basis, which means that nobody pays taxes on all of the appreciation that's accumulated in your lifetime. So let's go over a quick example. Let's say you bought a rental property for $100,000 many, many years ago. You hold it your entire life, or let's say you sell and you do a 1031 exchange, and upon passing, that original $100,000 is now worth $1 million. Well, when you pass away, your beneficiaries inherit the property at $1 million fair market value, which then means nobody pays the taxes on that $900,000 of appreciation in your lifetime. So you can see how real estate doesn't just provide you with cash flow and appreciation, but it also provides you with tax savings and is a really, really great tool to build generational wealth tax efficiently. So these are just some of the many tax benefits of owning rental real estate for current tax savings and generational tax savings. If you have questions, drop them in the comments below. I would love to answer them. So until next time.